Welcome, everyone, to our presentation tonight, Recession-Proofing Keys to Weathering a Potential Storm. We're delighted tonight to have two of our trusted advisors here to address your concerns about the economic environment we currently find ourselves in. These gentlemen are also going to provide some guidance on what to do next with your portfolios, and they are going to talk about active things that you can do right now related to where we are. I'd like to start, though, by thanking all of you for being such great clients. It's been a very eventful and somewhat challenging year for our entire team at Badger Investment Group, or as we like to call ourselves, BIG. I like that. I made that up. I do pride myself as your trusted advisor on always telling you what you need to hear versus what oftentimes you would prefer or like to hear. And as such, I'd like to begin tonight's presentation with some opening remarks on the performance of our portfolios. Statistically, the period from August 2018 to today has been one of the two most challenging and difficult performance periods for our portfolios in my 25 years of being in the business. That is the tough news for tonight, and I'm sure that's not what you wanted to hear. But it is a fact, and I'd like to think that I make a point of being straightforward and transparent with all of you. The other worst performance period occurred just before the tech crash in 2000, and I'm not predicting a crash, but in 1999 and early 2000, stock markets were on fire, and portfolios were, major markets were doing well. Our portfolios underperformed, much as they've underperformed this past year. But in early 2000, when the bear market hit, our performance, compared to the very difficult markets that followed, made up for a lot of the previous underperformance. And we hope that history is going to repeat itself in the very near future. I do want to reassure all of you that our move to Canaccord is not the cause of underperformance, and nor is it that we are doing anything differently than we did previously at Richardson with our strategies. At BIG, we do fundamentally believe that there is a significant change in how the market is going to behave going forward. The proof, however, will be in the pudding, and we do respectfully ask you for your continued patience and support, and we welcome the opportunity to discuss your portfolio's performance at any point in time that you'd like to have that conversation. And finally, before I turn over the mic to our two speakers, I also want to address a couple of key themes that we're going to be talking about tonight. Donald Trump. His tweets and his trade war are ruining my retirement. So I'm very much looking forward to it. It's not going to be as much in Javed's world in terms of the technical side, although he may get into Trump, I don't know. But I'm very interested and keen to hear what David thinks. Number two, a recession is coming. How do we get prepared for that? I will not try to suggest to you that there isn't a recession that's coming sometime, and it's coming sooner than it ever has been. So we want to think about and talk about how our portfolios are oriented towards that and what kind of things we can do to see our way through that. A third point, which may not be as much on people's radar, is that interest rates are at near all-time lows. And there are many who believe that in North America, interest rates could potentially go negative, as they have in Japan and Germany and many other developed nations. So what are the alternatives that we have to the stock market when interest rates are so low and they're not attractive? And I know Dave has got some commentary on that for sure. Our guests tonight, Javed and David, are here to provide you all with some thoughts on how we move forward from here. We'll also have an opportunity to ask them some questions. So I'm going to start with Javed Mirza. Javed is a vice president and technical analyst at Canaccord Genuity. He joined our Canadian research team as a technical analyst in 2017. He has more than 10 years of experience in technical analysis, most recently at another major investment dealer. Previously, he worked in finance at a Canadian bank and on the derivatives pricing desk at State Street, Canada. He's got a Bachelor of Commerce from the University of Toronto, received his MBA from Queen's. I know we've got some Queen's alumnus here as well. And he holds his CMT and CFA designations and is a member of both the Canadian Society of Technical Analysts and the Toronto CFA Society. He also won the Top Gun status in the 2016 Brendan Woods International Worldwide Equity Capital Markets Performance, which is, I know, probably not cool to you, but very cool to me. And without further ado, I'm going to bring Javed up to give us a presentation.
Thanks so much, Jeff. Thanks for having me, everyone. Hopefully I don't bring everything down here with a mic. Okay, thank you. So what I'm going to be talking to you about today, or I guess what we could call this presentation, is the more things change, the more they stay the same. So what I'm going to be talking to you about is markets, how human beings how markets are basically human emotion on paper. And when Jeff led out and with a talk that he gave here, a lot of that was about the emotion that we have with the markets, and especially with money. So money becomes very emotional, especially when you're losing money. And the two strongest emotions that we have in regards to money are fear and greed. So I'm going to be talking about that. I'm going to be walking you through the calls that we've made recently, our longer term outlook, and in general, what I want you to walk away with from after I give my presentation here is that we are extremely bullish on equity markets here. So the chart that I have in front of you right here is the chart of the S&P 500. I'm going to try and not get in the way. Those red boxes there highlight previous secular bear markets and equities. And what those are effectively sideways trading ranges. And the blue lines highlight secular bull markets and equities. And what those effectively are periods of sustained economic growth. And through history, what you can see here is the most recent secular bear market in equities was from the period of 2000 to 2010. And when we had the financial crisis lows in 2009, in our view, our work strongly suggests that that was the start of a new secular bull market in equities. And the reason that's important is because each of these previous secular bull markets and equities, the blue lines there, they lasted 20 to 25 years. So it's 2019 right now. The secular bull market started at the lows of the financial crisis in 2009. So our work suggests that we have upside to at least 2030 in this secular bull market in equities. So we remain extremely bullish here, and that was our call at the start of the year as well. If you guys recall, as Jeff highlighted, we had a really challenging period from August to December of this year. And there was a variety of factors, which I'm going to show you in a second, that from our view gave us strong conviction that it was time to step in and buy equities. So I'm going to walk you through all those steps, and they involve things outside of the realm of finance. And like I said, what my discipline focuses in on is emotion. Okay? So ultimately, when you drill down and you see these peaks and valleys, all of these are just human emotion. And this chart that you see here that's heading to the far right, what that chart represents is something that is very positive and very powerful, and that's human progress. Okay? So if you're investing in equities, the future is very bright. So what I'm going to talk about next is the 4-year cycle. And what you can see here with these horizontal lines, each of these represents a trough in the S&P 500. And just so you guys know, this chart here that we're highlighting is the S&P 500. And as if by clockwork, every 4 years, you have a major low, okay? And so this is the business cycle that you hear a lot of economists talking about. And I know a lot of you have heard chatter out there that we're very long in the cycle. And what I want to point out with this is that within this new longer-term secular bull market in equities that we see going out into the 2030s, you have these 4-year cycles, okay? So our work suggests that the lows we saw in December was the start of a new 4-year cycle. And if we are correct, and I know we've had some news about yield curve inversion, and I'm sure Jeff has forwarded on the work from Tony Dwyer, and the work he has done from a fundamental perspective is even when you get the yield curve inversion, and there's been a lot of recession chatter, that even when you get all these negative things, you still have another 2+ years of upside and typically another 20% of gains in equities. So from our perspective, we remain extremely bullish out into 2021. Once we come out into 2021, that's when we'll start getting a bit more cautious on equity markets, and that's when we want to start putting some more money into the more defensive areas of the market. But right now, we remain extremely bullish on the outlook for equities. So what I kind of want to walk you through is our thought process and what we were thinking back in December. So we originally published a note about the 4-year cycle. And what you can see on the left-hand side, and this is important, is these are all the 4-year cycles that occurred during secular bull markets and equities. Okay, so I'm just going to go back here. So the secular bull markets and equities, those were where the underlying economic conditions for growth were really strong. And then if you take a look at those red boxes, those are previous secular bear markets and equities. And those are illustrated on the right-hand side. And what we calculated for both of these was the average duration, so how long they lasted, and then the average drawdown, so how bad was the pain that investors felt. So if you're in a secular bull market in equities, the left-hand box there, on average, you lost 16% from peak to trough. And it lasted on average 34 weeks, okay? Then if you take a look during a bear market, and these are brutal, it's almost effectively double the damage, both in duration and in magnitude. So if you suffered through a bear market, a 4-year cycle trough during a secular bear market, on average you lost 34%, and these equity bear markets lasted 76 weeks. So the reason this is important, because we put out this piece in December, I think mid-December, and we told clients, and this is when the S&P 500 at this point was only down 12%. Okay, so we sent this note out to our entire list, and we said, look, if we reach either that 15% trigger or this pullback lasts more than 34 weeks, then it's time to step in and buy equities, okay? Now, there were a couple of other factors as well that led to our decision to make a call to buy equities. Right here is investor sentiment, okay? And when this, in December, when we made our call to buy equities, the reason we made that call is because investors were so bearish. So just so you guys know, I work in downtown Toronto, and this is at the end of December, and I won't forget, I was walking through, has anyone ever here been to Toronto? I assume some people have, okay. So I was walking downtown Toronto, and I could see the faces of the people, and this was in the financial district, and the faces of everyone there, they looked so glum and so shell-shocked that was one of the things that for me really drove home the point how bad sentiment was. That people were so shocked that it was so bearish out there. And that for me, and you can see that represented right here, that for me really was one of the triggers for why we said to buy stocks. So just so you know, we put out a note, Jeff can send it to you. This was 3 days before the low. We said 3 reasons to buy stocks. That was one of them. The second reason was, which we just highlighted, that we passed that 15% trigger. So as we got towards late December, the S&P 500 was down almost 20%. So it passed that 15% threshold that we had highlighted. Now, if you take a look just at the fourth panel there, what that is an indicator of, it's the percentage of stocks that basically have bullish technical patterns. So I'll give you a little bit of my history. When I was growing up, my dad was a stockbroker. And as a kid, one of the chores that he had for me was not to mow the lawn, but it was to go through the Globe and Mail and chart stocks by hand. Now, I didn't really find this fun as a kid back in the 80s, but it taught me a lot about charting and, from the school, I guess the education history that Jeff alluded to. I went to U of T. I did a BCom. It's a very math-heavy school, and then I'm a CFA charter holder. But I've always been drawn back to the technical aspects of markets because of how powerful they are and how useful they are. And that indicator was actually, the charts that I used to do by hand, that indicator shows you the percentage of stocks that have bullish patterns. And the key thing about this indicator is in December, we got to levels that we had not seen since the financial crisis in 2009, okay? So from our perspective, everything was flashing extremely bearish, and two things were gonna happen. One, the world was gonna end, or two, we were starting a new 4-year cycle. So our view was that we were starting a new 4-year cycle, and I showed you the work behind that. And so if we are starting a new 4-year cycle, so that means we started in 2019, that means we have upside out into at least 2021. And like I said, Tony put out a piece, which I'm sure Jeff has forwarded to you, that even with a yield curve inversion, we still have another 2 years and 24% of upside, and the 2 years of upside from 2019 takes us out into 2021. So it's always nice when different groups within the financial universe align. So it's nice when our technical work aligns with Tony's strategy work. So next, I just want to briefly talk about the market cycle model. So for those of you who delve more deeply into this, you know that economists talk about when you're late in the cycle, there's certain areas of the market that do better than others. But what I would like to draw your attention to is that within this secular bull market in equities that we saw, and I highlighted that blue arrow that from our work suggests we're going upside in equities at least till 2030. Within that, you have these smaller 4-year cycles. So this is the secular bull market in equities. And what we want to highlight is within the secular bull market in equities, you have these cycles, these peaks and troughs, and these last every 4 years. So we had the 2009 low, then we had a low in 2011, 2015. We just had another low in 2018, and the next low should be in 2021. So it's all these cycles that you see. And these are the same cycles you see that this chart illustrates that the stock markets have had since the 1950s. So what this market cycle model is useful for is within each of these 4-year cycles. I don't want to get into too much detail, but there's certain areas of the market that are going to be more impacted more beneficially and that you want to have greater access to. So I don't want to get into too much detail on this part, but I just want to highlight that you see a lot of strategists and economists talking about we're late cycle and that's why they're concerned. But within this longer term secular cycle, you have these 4-year cycles, and that's how they roll out. Next up, and this is what Jeff has alluded to as well, just talking about US 10-year yields and where they're going. And I know our next guest speaker, Dave Picton, is going to be talking about these as well. So from our technical work, We're seeing the bonds attempt to forge a triple bottom here. There were some positive developments that happened earlier this year, which suggested that yields were going to go higher. Of course, over the last 6 months, yields have taken quite a dive. But in general, we're going to be watching these, and from our work, it suggests that if we are in a new secular bull market in equities, then this should be somewhat supportive of a push higher in yields. So I'm just going to finish off just with our most recent market views and market calls. Over the last couple of weeks, we're seeing a similar repeat of what we saw earlier in May. Our work focuses both on the very long term, and we're able to drill down into the short term as well. But the bottom line is the indicators that we were looking at, so once again, investor sentiment and volume, all the things we look at as market technicians, highlighted to us as a fact that in August, it was actually a buying opportunity to add exposure to equities. And we're seeing that play out again. So in our view, stocks are poised to break out to new all-time highs. A move into new all-time highs by many stocks is extremely bullish and supports our very bullish thesis. And then finally, I just want to finish off here with, and I'll turn it over to Dave in a second, but just, I know Jeff was talking about yields and how that's going to impact your future investing allocation. And one of the really interesting things that's happened over the last couple of months is that the S&P 500 is now yielding a higher dividend than the actual US 10-year yield. So for our perspective, that really supports further upside in equities, as people who are investing in bonds for yield are now going to continue to shift into equities and support push higher in equities. So with that, I'll leave it there and turn it over to Jeff and Dave.
Thanks, Javid. And I have to say that Javid is somebody that I've been paying a lot of attention to since I joined Canaccord. He's been remarkable or uncanny for calling effectively what's happened with markets over the last 12 months. So we're using the work that he does with the work that Tony does, our U.S. macro analyst, to give us a good sense of where we're going with U.S. equity markets. So I heard you say, Javid, that you're bullish. Okay, well, that's a relief. Okay, and that's kind of contrary to what we're hearing. Okay, great. We're going to have Dave come up here now. I just want to appropriately introduce him. David and I have worked together for a long time. I've been a big supporter of Picton and what they've been doing at their shop. I don't know where your bio went, Dave. Here it is. So Dave is the president and CEO of Picton Mahoney. He's also a portfolio manager. He's a founding partner, and he's responsible for the Canadian Equity Market Neutral Fund, which many of you own. He also runs the long-short strategy and their long-only strategies at Picton. He's been a prominent presence in the Canadian investment industry for the past several decades. He's a lot older than me. Highlights of his career so far including launching his own asset management firm, Synergy Asset Management, and working as its lead Canadian momentum portfolio manager. Some of the mandates that he continues to manage this day originated at Synergy. He also spent 8 years as head of quantitative research at RBC Dominion Securities, where he's one of the top ranked analysts in his sector. He owns an honors Bachelor of Commerce degree from the UBC University. And I would say too that David's one of my favorite guys to talk markets with. I'm very fortunate that he makes himself available. I want to also thank him personally for making himself available tonight. Javid as well. We organized this seminar on short notice because we really felt that our clients wanted to hear about what was happening in markets, because there's been a lot of talk and concern about where we are today. So David, without further ado, Please join us.
Thank you, Jeff. Appreciate everybody coming out today. I understand many of you own some of our products, so we really thank you for your support. Us investment guys can be pretty boring, I got to admit. So I'm going to try and tell you my outlook on the market with a little story I heard. It kind of really sums it up succinctly. U.S. biker walks into a bar looking for a fight. He's angry. He sees a mild-mannered guy sitting over at a table. He walks over to the table, grabs the guy's beer, chugs it down, smashes the glass on the table, stands over the mild-mannered reporter. The mild-mannered guy bursts into tears. The biker is not expecting this. He goes, "What's your problem?" "Well, I got a lot of problems," says the guy through his tears. "Oh yeah, like what?" "Well, if you must know, I'll start about a dozen years ago. Mortgage broker approached me, said I could buy 2 times the size of house that I currently had for half the money every month in payments. So I took him up on his deal. It was around 2006, bought a house in the United States, had this crazy mortgage, didn't even look at the fine print. Next thing you know, the mortgage payments doubled and the house fell into the toilet and I lost the house." "Oh yeah?" says the biker. Yeah, we should stop there," says the mild-mannered gentleman. "I also was a white-collar employee at General Motors. We basically went bankrupt. The government bailed us out. Lost my job there, too." "Oh, yeah?" says the biker. Yeah, says the mild-mannered guy. "We should stop there. I used to have a medical program as part of General Motors. And so when I lost my job, I lost my benefits, my wife got ill, basically all of our life savings went out the window." "Really?" says the biker. Yeah, we should stop there." "What do you mean?" "Well, my grandparents had set up a trust for me for a rainy day. And so I went to access the trust, but it was managed by this guy called Bernie Madoff, and the trust was gone too." "Really?" says the biker. Wow, that is an incredible story. And the biker has a change of heart. He came in here with anger, frustration, and now he wants to help this guy. So he says, "Listen, man, I apologize for what happened earlier. I just had some bad stuff I had to work through, but this is a sign. You and I meeting is a sign. And I would like to take some of my ill-gotten gains over the years, and I'd like to help get you back on track." Yeah, well, the mild-mannered guy says, "Yeah, that's good, because basically I had come in here to have this beer and commit suicide when you showed up." Wow. So the biker says, "Well, listen, let's not do that. I'm going to tell you what. I'm going to go to the bar. I'm going to get a couple more beers for us. Let's sit down and work it out. Just promise me that you're willing to go through this process with me." And the guy says, "You know what? I got nothing else to lose. I'll do that." So as the biker turns around and walks to the bar to get a couple more beers, the mild-mannered guy yells out to him and says, "Listen, man, maybe you should call your doctor before you grab those beers." "Well, why would I do that?" "Well, the poison I was going to commit suicide with was in the beer that you drank at the beginning of the story." And that, believe it or not, is our economic outlook. Is there any questions or anything? No, I'm serious. Let me substitute some things. If you're the mild-mannered reporter, you're basically the average citizen across the world, especially United States, 10 years ago, in those darkest of times. You're down on your luck, you're feeling a whole bunch of pain, you're sad. The biker in our story is the world's central banks and governments. They swallowed an enormous amount of poison in terms of bad debt and all kinds of excesses to make the average person feel better. And it worked. It literally worked. Look at us now compared to literally this same time about a dozen or about 10 years ago, almost to the date. Can you imagine the difference that's taken place? The only problem is you have to deal with the poison. It's just not free. There's poison that's got to get taken out of the system. And that's where our story begins today. So if I may, just for a moment, jump ahead here. I believe that the U.S. Central Bank, in particular, decided it was time to get rid of the poison. It was time for us to take our lumps. And I believe they hiked interest rates way too dramatically, given the kind of the frail backdrop that the world economy exists in today. And I believe that them hiking interest rates that dramatically is what's caused that very quick 20% sell-off in the fourth quarter last year. And they panicked. They absolutely panicked. They thought they had this impunity to do whatever they want, to get some of that poison out of the system, to make us all better, and then they very quickly realized that no, that is not the case. We cannot do that. And I'll actually, never forget that December. Well, everyone will remember what, me personally, because it's my job, what Christmas Eve was like, as you see one of the very worst declines we've ever seen through the month of December take place on that day. That was, I think, the point at which Chairman Powell in particular realized, okay, we're doing things wrong. And what do I mean by that? Well, basically, if you look at interest rate increases through the years on this little chart, and there's some booklets here you can take away, these are the typical interest rate increases that occur in each of the major cycles going back through time. And the U.S. hiked interest rates 225 basis points. That's this blue line here. But they also did something else. They did this thing called quantitative easing that they flipped into quantitative tightening. They basically printed all kinds of free money and bought all kinds of bonds with it to lower interest rates. And then they stopped doing that and they started to sell the bonds. So if quantitative easing made everything better, quantitative tightening was probably going to do the opposite. So now I add quantitative tightening on top of interest rate increases, and this is the largest interest rate hiking cycle we have seen since a guy called Paul Volcker, when some of you may have had those mortgages with 20% or 18% coupons attached to them that you used to have to pay. So it doesn't seem like much, but in the world that we exist in today, where there's all kinds of secular forces forcing inflation down and where there's incredible amounts of debts that keep building every day, this kind of interest rate increase caused trouble. And when that occurred, we went into the typical late cycle problem that exists each and every time. The economy gets a little bit stronger, inflation starts to increase. There's actually a great quote that came out 2 years ago. It was, they have this thing called the Beige Book in the United States. The central banks do little surveys of the different regions. And a quote came in saying companies were having difficulty finding labor. And this one CEO said, yeah, we're having a difficult time finding labor that will pass our drug tests and show up for work. That's what they had left to choose from. And so, central banks sees these kind of things, they start to tighten, they go way too aggressively, and Javid mentioned long-term rates start to fall. They actually go recently lower than short-term rates. That's called the yield curve inverting. When that occurs, as he mentioned, you start the clock on the end of the cycle. It's a matter of time. Is it a couple of weeks? Is it a couple of years? We don't know. But you're now staring the teeth of the gale in the eyes, if you will. So when the yield curve inverts, there is a process that sets the S&P 500 to a peak, and then you get a recession. And in fact, if you looked around the world, because the U.S. hiked rates so aggressively and then decided that they were going to do trade wars and things like that, and by the way, I am a supporter of the Trump trade war. I'm not a supporter of him, but I am a supporter of the trade war because I think China cheats like crazy. I think it's about time someone took him on. But you throw those forces together, and now you get most of the world now in a recession. And you see underlying forces in the market telling you that things aren't good. So how's it going to play out? Well, this is fascinating because we're literally, in my opinion, right on the cusp. I believe, and I was telling Jeff this the other day, I believe literally by the end of the year, we're going to know whether the central bank in the United States saw the error of their ways in time to stop a disaster, or whether they didn't. Did they hike interest rates too aggressively, it's too late, or did they stop just in time and begin to lower them just in time? We're literally going to see the data play out over the next couple of months. This is a simple chart, looks at periods of time where the central bank has not made a mistake. They hiked rates, but they stopped just in time. This is what happens to the market. And then this is the times where they hiked rates, but they started to cut, but it was too late. And literally, the signal begins when they do their first cut, which they just did. After the first cut, the clock starts, and we're going to know in 3 months whether it's a recession or not. It's literally that close. So it's, to me, a fascinating environment. The other thing that's really fascinating about this environment is that you have all of this global uncertainty around the world. Major regions, whether it's Brexit, whether it's what's happening in China, whether it's emerging market recession, whether it's, well, who knows what happens south of the border. You see all of this uncertainty, and yet the volatility in the market is close to its lows. There is a big divergence between uncertainty and what the market is telling you right now. And again, you're going to see this resolve one way or the other in the next couple of months. Either the market's right, everything's fine, or you're going to start to see volatility increase to reflect the fact that it's too late. I'm going to give you what my scenario is here. It's kind of in line with Javid, actually. I think this is my highest probability view of what happens here. I started as a portfolio manager in 1997. In 1996, I used to work at RBC, where Javid actually used to work as well. And so my wife and I bought this fancy house, and we're literally, celebrating the house purchase. And this guy who used to be famous called Alan Greenspan, I don't know if anyone's heard of him, used to be a famous guy. He says 2 words. He says, the market is irrationally exuberant. What did he mean by that? Well, we went through a major crisis in real estate in 1990, like a major one. Like Canadian banks, one of them was almost insolvent. They had got stuck with the Reichman loans and some bunch of loans out of the U.S. and Central America. They were literally insolvent. And that occurred in a whole bunch of regions around the world. And the central banks flooded the system with money, just like they did in 2008. And then a couple of years later, things began to get better. And so by the time we get into 1995 and 1996, Alan Greenspan is hiking rates. And the U.S. dollar is going up. And by the way, when the U.S. dollar goes up against the world, that's not good. Because the rest of the world needs the U.S. dollar to be lower, because they use U.S. dollars to finance their debt. And when it goes up, they get in trouble. So it's 1996. Interest rates are going up, and the U.S. dollar is going up. And the markets are doing nothing. They're perfectly flat and happy. And so Greenspan says, it's irrationally exuberant out here. And the market literally did this. A little bit of a hiccup, and then just continued on its merry ways. Kind of reminded me like 2017. You guys remember 2017 at all? No volatility, all stocks went up all the time. Bonds went up, stocks went up. Amazing. Great year. Meanwhile, back into our story in 1996, now it's 1997, rates are going up, the US dollar is going up, things start to get a little bit dicey, and the first shot across the bow occurs. Thailand, which needs US dollars to finance its consumption, got into a problem. Their currency was too high. Their currency collapsed 50%. It took a couple of months to do it. And suddenly, the Asian economies go into what's called the Asian crisis in 1997. That kind of reminded me of the beginning of 2018. Turkey gets into trouble. Their currency falls dramatically. Bonds go down across the world. Stocks go down across the world. And then, all of a sudden, everything's fine. So we had that little hiccup in 1997, and the markets over here continue to go higher, just like they did this time. 2018 into the summer, everything's fine. Back to 1997, now the rates are going higher in the US dollar is going higher, and then we get into the granddaddy event in 1998. Russia, in the middle of this bull market for US and Canadian equities, in 1998, in the summer, I'm in my hometown of Canaccord, BC, plug in the dial-up modem to see what's going on in the market, and Russia's defaulted on its debt. Russia is also a country that's heavily reliant on the US dollar and energy prices. And at the same time, this little company called Long-Term Capital got levered 100 to 1 on some bonds that they'd bought, and the trade didn't work. And so now they're insolvent. And so within the course of 6 weeks, the S&P 500 fell 20%. And this guy called Alan Greenspan panicked. It's like, oh my goodness, I think I like the irrationally exuberant days. I don't know what's going on here. And he cut rates 3 times in basically 6 weeks. So 1998, the market started here, went up, gave it all back, fell 20% in 6 weeks, and then 2 months later was back to its all-time highs. And then 1999 continued to soar. And then it was done. I kind of think we're setting up for something like that. I believe that in the next couple of days, you're going to see the European Central Bank do something crazy. I don't know what it is, but they're going to do something crazy because they have to, because Europe's economy is going like this. You're going to see Chairman Powell in the U.S. They're going to do something crazy. They're going to cut rates, hopefully 50 basis points. And then you're going to see this market gain a bit of traction and do something wild. And hopefully, if I go back to those graphs where it goes like this or goes like this, hopefully it goes like this. And then you're for sure on borrowed time. You get your affairs in order in your portfolios, you have a little bit of fun, and then you get ready for the end of it, because that poison's still got to come out of the system. Jeff, why don't we wrap it up there? Thank you.
Okay, that's great. We're going to do a little question and answer, so we'll get an opportunity to maybe dig in on some of the stuff that the guys have talked about. It's great. That's what makes a market, is bright minds who've got views and opinions. Okay, continue to eat and enjoy, and we're just going to go through a few questions that I have for the guys, and then anything that you would like to ask. So, Javid, I wasn't quite sure, based on your presentation, whether you're bullish or bearish. So, December 2018 was a reset for the 4-year bull market. Would you hold true to that, even if we have a recession that shows up, sometime? I mean, Dave says it could be in 4 minutes. I hope Dave's been wrong a few times, so hopefully he's wrong on that one. But what do you think about a recession, and is it still intact if there is a recession?
100%. So what I would say is, if I was going to draw a parallel, I know Dave highlighted the 1998 parallel, the Asian crisis, and just so you know, that was 1998, which is another 4-year cycle low. And that was in the secular bull market that took place from the 80s to the 2000s. So the parallel that I would draw is the 1990 recession. So especially as a Canadian, I lived through that recession. That was really tough. My father lost his job, so I remember that clearly. It was not a fun time. But if you recall, and for those of you who have my piece in front of you, if you take a look at that long-term map of the S&P 500, it was effectively a sideways blip. And so our view is we see equity market upside into 2021. That's when we'll see the stock market effects of the recession. Okay, that's when we'll see the stock market come off. You've seen my work on the 4-year cycle, so typically a 15 to 20% decline. And this bull market, the secular bull market, should run through to 2030. So no change in view from the work that I do.
Okay, great. I like that. Okay, David, for you, 2 words: Donald Trump. In your mind, how has Donald been good for the economy? How has he been bad? And then if you could just finish with how you think that's actually going to affect markets in your mind, because I know that there's an obsession out there with what he does, what he tweets, what he says, whatever. Can we rise above that noise?
Those are 2 big words. Donald Trump is born in an era of protest. The symbol for the Republican Party is the elephant. And there's a very famous graph called the elephant graph that emerged over the last couple of years in economic kind of literature, trying to explain how this guy even got elected in the first place. And what it is a graph that goes like this. We have it in our package. It goes up like this, and then here's the head of the elephant, and it comes down, and then here's the trunk. And what that graph is, this is the increase. This is how much money you started with, 0 to lots. And this is the increase in your kind of standard of living over the last 20 years as the world went more global. So if you were a poor peasant in the middle of nowhere, in an emerging market somewhere, you see an amazing increase in the standard of living, all the way up to where you're about the 50th percentile of kind of wealthy person in the world. And then at that point, the top of the head of the elephant graph occurs, and then you see this collapse, where literally for 20 years your standard of living went nowhere, down to 0. And that right there is the middle class voter around the world. And then of course the big snout is the 1% who have literally coined it and made an amazing amount of money. So this area is what keeps this guy around. And this area is where all the policies are trying to be targeted towards. And most of them are pretty good. I'm not going to talk about the environment because we don't have to talk about that. But the amount of regulatory burden that this guy removed is immense. Let's give you one example. You're a small business owner. It's 2008 or 9 in the United States. First of all, you go through that horrific downturn. Then the banks pull your lines of credit. Then this guy gets elected called Obama, and he throws a whole brand new regulatory regime on top of you, and Barney Frank and those guys, and they load you full of new rules. And then he puts Obamacare on top of you, and your costs go even higher. And then he is so weak to the rest of the world that they start taking advantage of the United States, and they cheat on every trade policy possible. So this small business owner in the United States is going like this, just trying to survive. And then he wakes up in 2016 with this new guy elected. And what happens immediately? His regulatory burden is cut in half. The Obama taxes that he pays, they go out the window. His taxes are cut. His customers' taxes are cut. And then his president goes after every single trading partner you have, including Canada. I mean, seriously. So that small business owner in the United States has not felt this good for 20 plus years, at least. And they're ready to spend. So the China thing is going to take a bit of time to work its way through, but you get through that, you get rates falling around the world, he's been good for the economy. Other things I'm not going to comment on.
I couldn't agree more. I do not like the man. I would not have him over for dinner.
Nope.
But I think a lot of those things you talk about, and Tony Dwyer, who's our U.S. macro strategist, talks all the time about small business confidence in the United States and how that is so huge to what's going on in the economy. So that's a real dovetail, a real resonance. All right, Javid. How does the work that you're doing dovetail with the macro research that's being done by Tony? So how does this support kind of your view for the next 6 to 12 months? Because I know that Tony is a little bit more optimistic than you. His price target's a little bit higher on the S&P, but like, you know, you guys, a lot of, when I read both of your guys' research, I see a lot of congruency.
Yeah, we're in lockstep. And just recall, my price target here, 3,100, that's just for the next 2 months.
Okay.
So once we have our 4-year cycle target, we're going to do our quarterly strategy update at the end of September, and then you can send it to anyone on here who's interested. I'll put our longer term target in there, but it's going to be much higher for the next 2 years. Okay. So yeah, we've been in line with Tony's view. So it's nice because what I really like about it, just from the outside looking in, is I have my own discipline, my own approach, and Tony has his own discipline and his own approach. And when the two align, it's really powerful. And the work that I do, So I look at things from from a technical and quantitative side, and then we have our individual stock analysts who look at it from a fundamental side. And then when we're talking about these ideas to institutional clients, it really resonates from their perspective when you have all these disciplines aligning. So when you have these multiple disciplines aligning, it's really powerful.
Yeah, and I think the thing that's important to understand is that Javid is more of a psychologist than anything, and I just that's the kind of the cool thing about technical analysis. It seems like it's scientific and it's math and it's whatnot, but it's really the emotions, the human emotions associated with taking risk. David, we're on a theme here. 2 more words: Justin Trudeau. Now, we just had a blowout employment number in Canada. We had 180,000 jobs in Canada, which was 50,000 more than the United States in the last number that we saw for the month. And Canadian GDP is actually currently outpacing U.S. GDP, and it doesn't feel like it for us who live in Alberta. I mean, like here, it's horrible. I mean, you're not really an Eastern bum. I mean, I know you live there, but you're from BC. We kind of hate you for that a little bit too, but whatever. You like to ski, so I don't know. We're meeting somewhere in the middle. But do you think that this GDP number, the employment statistics, and kind of the good news economic story is sustainable in Canada? And then the follow-on would be, if a recession's coming in the U.S., what do you think that looks like for Canada? Will there be a recession here sooner? Like, just your view on those things.
The good news about Justin Trudeau is he's done absolutely nothing. Like Zippo, there's not a single policy you can point to. But that is good news. That's generally, if you leave a great country status quo and you don't leave it worse for wear when you're done with, that's an amazing thing to do. I will agree with one amazing policy he has had, and it is the key driver of this stuff, is the Canada's policy on immigration. We are winning huge as a result of that. We win. We get the very best of what's available in the world. They're coming to Canada. You're starting to get migration from the U.S. into Canada. We win. We win huge. And it has been a massive driver of our relative GDP performance against the U.S. In fact, most countries in the world where they are closing down the barriers as fast as they can. So I will give him absolutely credit for that. I think we're on borrowed time, though, because I think that if you go back to the 2008 mess, what happened in the United States, they had very expensive housing prices. They had consumer debt that was very extended. And they had a whole bunch of crazy policies like no money down, you could buy a house. And in Canada, we were the picture of prudence. We were in the middle of a resource bull market, so even though 2008 happened, we still had a resource bull market. We had consumers that didn't have as much debt, and our housing prices were reasonable. Fast forward to today, and we have literally flipped that compared to the United States. The United States housing market is much more affordable, other than a few spots like San Francisco. Their consumer debt is dramatically better than ours now. And we have had basically the rise of home equity loans, et cetera, that has pushed personal and private debt to levels we've never had before. Goldman Sachs did an amazing study looking at countries where their private sector debt becomes more than their assets, which is now in Canada. And those countries, if you look forward over the next cycle, are generally the lowest performing on the list. We now have, along with the UK, the highest private sector net imbalance of any of the major developed countries in the world. So we've had a good run, amazingly good run. I know it hasn't been as good here because of the oil issues, but in Canada we've had a good run, but a lot of that has been borrowed from the future, I think, and there's going to be a little bit of a payback to it.
Okay, before I open it up to questions, I do want to give each of our speakers a little chance to talk their book, and it's a little unfair to Javid because he doesn't run a portfolio of...
We have the U.S. and Canadian focus.
Sure. If you want to talk a little bit about that, that would be great. And one of the other things that we've had the benefit of doing too for the people in the crowd, Javid has done an analysis of the Badger Investment Group's portfolios. And that was a great, just as he does with Tony, where they collaborate and they talk, how their views sort of converge and whatnot. What I said to Javid was like, would you look at our individual portfolios and give me your humble opinion? So maybe talk a little bit about that and some of the work that you're doing on the portfolios.
Perfect. What I'd like to add on to is the comments Dave just made. I think they're very important, and they're looking forward. And what I wanted to highlight, if you guys remember that the crucial chart that I have of the S&P 500 with the blue arrows and the red boxes. So those last two red boxes, those are secular bear markets and equities, but they were also secular bull markets in commodities. Okay, so the 70s to the 80s, and then most recently 2000 to 2010. So what that means longer term, it was amazing to own Canadian equities from 2000 to 2008, 2009. Yeah. Now, not so much. So I just want to talk high level. What I'd be talking to Jeff about is kind of future-proofing your portfolio over the next 10 years. And what I mean by that is, we have this view, secular bull market in equities out to the 2030s. But what that means is it's going to be driven by the U.S. So I'd be shifting part of my portfolio away from Canada and into the U.S. So that's one of the important things, is that resources are under pressure here. And you can see that here and with energy in general. And then just in terms of our portfolios, we have the Canadian, and we just launched the U.S. Focus Equity Portfolio. It's basically a benchmark portfolio designed to outperform the TSX or the S&P 500. So we've had the Canadian portfolio for the last 2 years, and we've outperformed the TSX composite. It's been a bit volatile, but it's been anywhere from 500 to 200 basis points. I guess I'll turn it over to Dave for some of his thoughts.
Well, and so Dave, we own a number of your strategies, some which you manage directly, and then others where you've got input from an overview perspective. But we own the Market Neutral Fund, which you've had a great year, Income Opportunities, and the Diversified and the Multi-Asset Strategy. So how can Picton Mahoney specifically help our clients in combination with some of the other stuff that we're doing? Like, what are your thoughts on that?
My parents always ask me exactly what I do, and then they try and explain to their friends what we do, and something gets lost in translation. So I'm going to come up with a new angle on this. We have 150 years of stock and bond market data, believe it or not, available. And so over 150 years, the U.S. stock market has returned 9.1%. And over 150 years, the U.S. bond market has returned 4.7%. Which one should you own? It's not a trick question or anything. If you have a 150-year time horizon, you should absolutely own only equities and nothing else. You should be like Warren Buffett. Never touch a bond, never touch anything else.
Yeah, well, my dad thinks he's going to live to be 150.
Yeah, well, there you go. Get him invested.
Okay.
Hurry up.
But for the rest of us humans.
By the way, remind me to tell you about a story about that. So the only problem with that 150-year 9% return in equities is you had to go through a 80% downturn in 1930, 50% downturn around 2008, and about 3 or 4 40% downturns. The magic was that each time those occurred, the bond market went up, in some cases double digit. And so then if you look at just the bond market, it had a much more stable return, 4.7%. But even it had times where it went down 12, 15%, like bonds, safe, risk-free. But when they went down, the stock market went up. So some wise guy along the way said, well, you can get a pretty good return in equities, but when they go down, these bonds go up. What happens if we combine the two together? And so this was born, the balanced portfolio. 60% stocks, 40% bonds. And because those two assets acted differently, when this one went down, this one went up, and vice versa, the ride became a whole lot smoother to everybody. You never had those 50% drawdowns. You didn't have anything like that. And our entire industry revolves around this concept working. You should have equities in your portfolios, and you should have bonds. And because the two of them act differently, you put them together, and that is the magic of our industry. Really, it's as simple as that. If Jeff builds your portfolio and every single thing is going up at the same time, you do not have a portfolio. You have a bet. You are making a bet. And when bets are made, they don't always work out, especially over shorter time frames. So believe it or not, you want to have these pieces that are acting at different kind of times in your portfolio. And by doing that, you will increase the certainty of reaching your long-term goals. That's where we come in. So if you have stocks that are doing this and bonds that are doing this in a different pattern, well, why did you stop there? Why don't you add some other things in? Because if these two things act great and they increase your risk-adjusted return because they act differently with each other, throw in a third thing that acts differently. Throw in a fourth thing that acts differently. And we've done a massive amount of research that shows every time you add in a positive returning asset that has a different return profile that acts differently than your stocks and bonds, you will boost the risk-adjusted returns of your portfolio. In other words, if you want to get a certain return here, you'll have to take less risk to get it. Or if you're only prepared to take this much risk, you can generate a higher return at that level of risk. And that, to me, is the huge opportunity that exists in the market today. Because everybody knows what stocks and bonds are. Less people know what a market neutral fund or a commodity, how it works, or what a volatility exposure looks like in a portfolio. And those are the things that we kind of slowly bring into the mix. So we like working with guys like Jeff because they understand portfolio construction. They understand that some of the things they do might go in and out of favor. They combine it with other people that might go in and out of favor. If they're smart people with good long-term returns, that combination is magic. At least I believe so, wholeheartedly. And so that's what we do. So any one of the products that you have probably is serving a particular need to act differently than what you might already have in the mix.
Great. Okay, well, so thanks, David, and thanks, Javid. So if there's anyone else that has a question or something they'd like to ask of our speakers, happy to do that.
Dave, you talked about you weren't certain whether it was going that way or this way, but then you went like that. If it's going, he talks about going to 2030. Where do you talk about going to?
I think we have, if we go up, we have a year.
A year?
Yeah, it'll be a great year, but we have a year. And then you go through, there's different kinds of bull markets, if you will. There is this kind of cycle thing that Javid referred to. Yeah. Well, we're not going to have 4 years. We're not at the beginning of it. We're at least halfway through that 4-year thing. So to me, you throw a year on it before you go through the corrective phase. And you just hope that that correction is much less painful than where we've been. And I believe that will be the case. We're not going into a 2008 anytime soon. We don't have the excesses that existed in 2008, the crippling of the financial system. That's not going to happen. But I do believe you can have the economic cycle go like this.
So Javid, maybe you can help provide color on this. And I asked that question, if there's a recession, like your bull market story to 2021 contemplates that the market in that period could drop
100%.
18% or 19%.
Yep.
It could, so they're not mutually exclusive. Javid's not saying that the market's here and it's going on a straight line in a positive way.
Yeah. So what I'm saying is we have clear upside to 2030. And I think you actually got what I was saying, is that we have upside to 2021. And then, I don't know when in 2021 is going to occur. Maybe it occurs early 2022. Yeah. Yes, but I think it's a 15% correction. And then we have the next 4-year cycle. That takes us from 2021 to 2025. And then we have another 4-year cycle. I think we have another 3 of these. So the correction takes place in 2021. Exactly, yeah.
Again, an understanding that, this is what makes a market. You can pick up the phone on any day, and like these guys are incredibly intelligent. They have incredible experience, and you'll get a different perspective or a view. And what I would say is that I hope, for these guys, I mean, neither of them would say, this is exactly how it's going to happen. This is what I think. And so this is how I take risk. Oh, I would say the majority.
And that's not a good thing, by the way. When most people have a view, you usually get your butt kind of shot off the odd time. Yeah, that's why I really think this next month or two is critical, and it includes a major ECB, European Central Bank decision coming out literally, I think it's tomorrow or the day after, where I think they just changed the game. And then you've got a major U.S. Central Bank rate decision next Wednesday, where they, I think, are going to go 50 basis points if they're smart. And then you get a China-Trump resolution at some point in time before the election. So if those things fall into place, this is going to be an extremely happy environment for some period of time before it, to me, kind of mushroom clouds out a little bit.
And sorry, Jeff, you want to?
Well, we could do a little survey here right now. If everyone's honest, and if all your clients here, if they close their eyes, we can just say who here is very bearish, and then Jeff can just count. He's not going to name any names, but it's a good way of finding out what the sentiment is in this room. And what I want to highlight is back in December, when we made that call to buy stocks, sentiment was extremely bearish. And just the headlines that Dave was talking about with China, there is a lot of things overhanging the market right now that causes me to be scared. Like when I said, I've been telling clients over the last 3 weeks to buy stocks, but it's not an easy call. I'm not just out there, hey, you know what I mean? Like it weighs on me. It's a tough call, but from the work we do, it's the right call.
And that's one of the reasons that I really respect both of these gentlemen, is that they put their reputations on the line with what their calls are. David in the sense of the money that he manages, Javid in the sense that he's publishing his research to the entire sales force at Canaccord and our institutional clients. And Javid and I were having a little chat in the break. Javid's going to provide me with some information about his team's calls over the course of the last 12 months. Like we said, do this, we said, do this, we said, do this. And he's going to demonstrate how that those calls went against what actually happened in the market. And this is the reason why Javid's here tonight, is that I've watched and listened to what he's done in the time that I've been at Canaccord, and I've been very impressed with the results. And it's not to say that, tonight we're all going to run out and we're going to go to, all your accounts and, bet it all on the equity market, because as Dave was alluding, it's important to have a balanced approach. But, we're getting a lot of questions and concerns from clients about, we're hearing all these negative things. The recession is coming. The yield curve's inverted. No one even knew what that meant. For my first 25 years in the business, I've never been asked. I've had calls like, what about this inverted yield curve? I'm like, wow, that's crazy. Clients are actually asking about that because it's happened a few times in my career. But, I think that's the thing that's good for us all to leave tonight with the understanding of, very bright people who are every day, day in, day out, living in the market, thinking about the market, talking about what to do, and some consistencies, but some divergence. And again, that's why it's not a science, it's an art as to how you manage risk in your portfolios.
I'll add two things. So I agree with Javid. He made a very good point. When everybody is running scared, generally it's the time to invest some money. And when everybody is incredibly bullish and buoyant, it's generally time to take a little bit of money off the table. I'm pretty well convinced that 95% of the people in this room believe wholeheartedly that the very best stocks to own are dividend-paying stocks. Income, look at this great yield compared to this yield that I used to get. I am convinced that the world is so enthralled, entranced with yield stocks that is where the action is going to happen. And the stuff that might affect you guys locally, energy or whatever, no one wants to touch that stuff with a 1,000-foot pole. And there's reasons we could go into that. But that's the stuff that is the fear. That is where the fear resides. Canadian commodity stocks, which he highlighted a little bit of, even the banking stocks around the world, that's where the fear resides. It does not reside in BCE or TELUS or whatever XYZ, TransCanada, any of those things. That's what everybody owns, huge, and that's where I think they're going to become more vulnerable than they think over time.
Yeah. Javid?
Yeah, so it's funny because I 100% echo Dave's concerns. That's a whole other wormhole we can go down about the dividend low volatility. It actually really scares me. Yeah, so what I would say in terms of Canadian equities, there's a lot of Canadian stocks that look fantastic, that are great, but then there's areas of the Canadian market that I'd be concerned about. And so what we've talked about in our work over the last, I would call 6 years, is we're in a very similar period that we were in the 80s to the 2000s. So Canada is going to underperform the US. And what I mean by that is, I don't mean we're going to have negative returns in Canada, but what I do mean is if the S&P 500 on average is going to return 10 to 12%, the TSX is going to return 8 to 10%. So it's going to underperform. So at the margin, I don't know if you want to make it 5%, 10%. That's, Jeff's the one to talk to about that, but I'd be allocating more equities, more of your allocation, overall allocation, to U.S. equities. Does that answer your question a little bit? Oh yeah, for sure. Just from our work, and Dave, I'm not sure if you drill down into the sectors, but what we like is staples, communication services. We really like infotech. That's our number one favorite sector in Canada. So a lot of those names we've highlighted on our focus list. If you're interested in specific names, we have our focus equity portfolio, which Jeff can send you. But those are the big names that really stand out there.
The other thing that we can do, if you have a name, like a Canadian name that you're really interested in, Javid will do a full workup. Yeah?
You know that saying, it takes two to make a market? So if we go into this scenario where the central banks cut rates and everything's great and there's buoyant, I agree with what Javid just said. Just like in 1998, the stocks that went down the most were the technology stocks, the growth stocks, and then when the central bank ironed things out, those are the things that went screaming to new highs. Everything that was technology related went screaming to new highs. And then if we all remember the year 2000, they exploded and new leadership emerged. So my working theory is, and the way we're kind of putting our portfolios together is, the leadership, the technology, the rate sensitive stuff, I think when they cut rates has a really good go. And then below the surface, what I think is happening is that the real value is going to be emerging in things like a Canadian commodity stock like First Quantum. I'll give you an example. It takes about 7 or 8 years to go through the process of finding ore, finding copper in the ground, building a mine plan for it, financing it, building out the mine, and getting the stuff on. And a lot of this stuff came on in 2011, and all the projects began just as the Chinese demand peaked out and went down. And we've gone literally 8 years now of grinding through all of these mines coming on stream and all of their commodities having to be absorbed and prices being incredibly low along the way. Well, what happens when that occurs, and you're seeing this in the oil patch now, when prices are low, people cut back on their spending, they don't try and find anything, they kind of go into survival mode. And this has happened in copper. So First Quantum has the last great copper mine coming on stream this year into next. And after that, there is literally not a major copper project on the boards anywhere for the next at least 3 to 4 years. So we're going to get to this point where if we get an accelerating economy, there's no inventory of copper, there's no projects of copper, and there is, to me, this runway for a massive move. I think after we have our nice recovery rally and we go through the next corrective phase, whatever year from now, the leadership coming out of that is going to be completely different than what people own today. And I would put First Quantum as, if it still exists, if it's not taken out, It will be one of the top 5 performers in Canada, is my humble belief. Highly levered company, though. Highly levered.
It's ironic because we just featured that last week as one of our charts of the week, First Quantum. So from a technical perspective, it looks, it looks really good here. Yeah, well, it looks, if there ever was a timely entry point, and I didn't really get into it in the presentation, but you have the presentation in front of you. A big thing that we look at is the smart money. And what that is it's the producers, they have the more information. So for those of you who are interested in commodities, we actually highlighted this week that on copper, the smart money is really long. So it's setting up nicely here for a trade.
Yeah, and Javid, just while you're on commodities, gold and oil, just your high level, what do you think about gold and oil?
So oil, my concern, like I said, we're in a commodity bear market, a secular bear, which we see going to 2030. So you can have these violent rallies. And for those of you who are more, I guess, kind of savvy in the investing arena, one of the things that I would look at to confirm this is the CRB index. It's just the broader commodity index. And what you can see is it's just this longer term downtrend of lower highs and lower lows. But you can get these extremely powerful rallies of 20, 30, 40%, like we're talking about First Quantum. But what I wanted to highlight on gold specifically, back in April, we were very bullish on gold. There was a couple of things that set up positively for a rally. One of them was smart money positioning, another one was seasonality, and then the third one was just the price setup. Over the last 2 months, we've been extremely cautious on gold and gold equities. Now, we like the longer-term breakout. That's positive. But if you want to buy gold or gold equities, we'd wait at least another month, month and a half. We think you're going to get a better entry point. The work that we do is all, ultimately, it's all about reward and risk. And the reward-risk ratio right here is not great.
Any other questions from the audience?
I read an article in the paper today about from Diane Francis talking about Trudeau's performance on employment, and it sounded like there was some gimmicky stuff going on, like counting employment from self-employed people. I think it was about $27,000 or $28,000. So, I mean, I listened to what you said there that. She has a dramatically different idea of what's happened lately in the employment market.
To me, I would follow the currency. The currency is like your stock price for your country. And in spite of, and I'm not exaggerating, I talked to a lot of U.S. hedge fund managers who are incredibly negative on Canada for some of the reasons I mentioned: too much debt, banks this, oil that. That currency, in the midst of turmoil, is not going down, it's going up. And to me, that was specifically coming out of that jobs number. And no offense to Diane Francis, but the market, the thousands of billions of collective minds that are deciding it, are deciding that those numbers are real and they're more positive than they would have thought they'd be. So that would be the answer.
So I think that's another one that's probably interesting to everybody here. U.S. dollar, Canadian dollar. What's your view on where we're going, Javid and Dave?
Yeah, my view is that the Canadian dollar is like the risk-on, risk-off currency. So when people get a little bit more buoyant, when the system is actually doing a little bit better, we magically catch a bit of a bid. But that we're going to be the whipping poster boy for the downturn. And so I think we can be better, and then I do believe we're going to crack 70 at some point in time. I don't think it's sustainable here.
You think into the 60s?
Yeah, absolutely.
What would your time frame on that be? 18 months? Or?
Yeah, when you go through, hopefully the Fed cuts rates and we get all this and we get some buoyancy and everything kind of goes like this, and then it plays out the end of the cycle. At that point in time, call it a year, plus or minus. I would be very cautious on the Canadian dollar.
I 100% echo Dave's thoughts. So our view, when we first started, became a publishing analyst, that was two of the things we talked about is Canada, the TSX underperforming the S&P 500, and the other one was the Canadian dollar heading lower. So we think it's going to go back to where we saw at the low, so around, at the very least, around 60 cents. This is not going to happen overnight. This is going to happen over the next 10 years. But the beautiful thing is, in 10 years from now, that's when the commodities will be at a real big trough in the Canadian dollar. And that's when you want to switch, bring the money that you've invested abroad home, because it's going to be a magical wonderland for Canada.
And that dovetails a little bit with your view on U.S. equities versus Canadian.
100%.
So
yeah.
owning U.S. dollars is going to, like, from a secular perspective, from a next 10-year perspective, better off to own.
I'm going to, talk my book here, as
Yeah.
you were saying. So in my personal investment account, I took all the money, converted it to U.S. dollars. I mean, I have different accounts, but my largest account,
Yeah.
I converted it to U.S. dollars, and I hold U.S. equities.
Cool.
Can I talk my book?
Talk your book.
Our firm's gone through a lot of restructuring. We've recently done our first acquisition. So all of us, Andrew Milne over there is one of my partners, we're only really allowed to invest in our firm or in our products. So my money is basically real estate, that, home, cottage, whatever, our firm, and the products that we manage. And so I'm fully invested at all times. And so I really felt that we were setting up for a good kind of the way we do things run. And so I actually went and borrowed $1 million on my line of credit and bought our market neutral fund last year, just to kind of give me leverage, if you will, to the things that our firm is doing.
And you've had your best year in?
Couple years.
I've noticed. I hope those of you that own it have noticed. So we're pushing on 8:30. I just want to make sure if anyone's got a question or anything they'd like to discuss. I think we're good. Look, I want to thank a few people that do a great job and probably don't get thanked enough. I would start with my assistant, Rose Fleming. She's amazing. And a woman who's persevered through a lot of tough stuff in the last year. Many of you know that her husband has been through a tremendous amount. And I just love how committed she is to our clients. I know you guys all really appreciate her and all that she does for you, and I really appreciate that as well. And unfortunately, Lex has recently been in the hospital, but is getting better. So the thumbs up. You were to see him just before you came here, and things are getting better. Great. So I know everyone knows about Lex and cares. I also want to thank Tatum Watson, my daughter, stepdaughter, who has worked with me this summer. She's done a phenomenal job and was involved, obviously, in the organization of tonight. But she's been phenomenal. She actually worked for Dave and did a great job. Supported Andrew, and I want to thank Andrew very much, who is my supplier, as I call them, for Picton Mahoney. Andrew's been amazing in terms of helping us, in supporting us in owning the products that are at Picton, but providing us with the information, getting Dave here tonight, which was phenomenal, and just being incredibly supportive. So I really appreciate, Andrew, all the work that you do. My wife's sitting over there. I'm going to say thank you to my wife. She puts up with all my crap and sees me through all the difficult things. Cheryl, yeah, that's a lot of stuff. And again, I want to thank all of you as clients. It hasn't been a great year, and we have conversations, but you've all been incredibly patient, incredibly fair. I hope that tonight has been helpful for you in terms of getting a better grasp on where things are at. And where we may be going from here. I'm optimistic, and I think that we're a bit of an outlier in that in the short term to medium term, and again we've got a little divergence here as far as that goes, but it's not as bad as people think it is, and the market tends to climb a wall of worry, and so the more people are negative, that's something to take with you. Emotionally, it doesn't feel like we should be taking more risk, but when the majority of people think that it's time to get out of the market, that's probably the time to stay in. And Javid has
So what I would add from that, and I think Dave has heard this in some form, and some of you here might have as well, just a great point. When you want to get out of the market is when your Uber driver starts giving you stock tips.
Right. Or your hairdresser.
Yeah.
So anyhow, thank you very much
Especially
for
your
coming
hairdresser.
tonight. Thank you very much to Picton for their support. Javid, thank you very much for making the trip out to Edmonton for this event on short notice. And please, there's a little more bologna there. And help yourself, have a drink, relax, enjoy yourself if you want to stay. And thank you very much for coming. I really appreciate it.